Yeah, hi there. That's back to reality. So the markets woke up this morning to full-blown currency wars. So the People's Bank of China uh, quite clearly stated that it is retaliating to the Trump administration's announcement of further tariffs that they want to implement on September 1st. So the sequence of events was very interesting. So you had Powell giving the market some relief on the yield curve by lowering rates by 25 basis points, but unfortunately, when he gave his press conference, he wasn't forthcoming enough about more rate cuts, so that disappointed the market already in the middle of the week. Then you had the announcement the next day that the Trump administration would levy another 10% on roughly 300 billion of goods coming from China, and that would happen September 1st. So on the weekend, we obviously had the tragic shootings here in the U.S., which is, of course, troubling to any American. But from a capital markets point of view, the Chinese have gone full-blown currency war here by basically saying we're going to intervene in our own currency, which is their currency, to offset the effect of the tariff. So it's interesting if you look at the Chinese currency, it's already gone down about 6 or 7%. So the Chinese currency, which is called the renminbi, also known as the yuan, basically is around 7 yuan to one renminbi to $1. That's quite a move in currencies, and that's if you look at currencies all over the world, given all the trade and supply chains that exist around the world, if you have these enormous moves in currencies around the world, it really upsets economies. One thing that's really troubling as well, if you look abroad, if you look to German yields of Bunds, which are the German Treasuries, the entire yield curve in Germany is now negative. So if you're saving money, you are not getting an interest rate, you have to pay to save money. Think about the Germans who have, since the Weimar Republic days, when you had their currency go to zero, and this is something culturally that's kind of ingrained in the German culture, and why Germans save so much money. The savings rate in Germany has always been double digit, between 10 and 20%. This is something that is ingrained in their culture because they lost their currency once. So it's quite interesting to see here what the effect will have of these negative interest rates going forward. Germans are still saving money. It's interesting, even here in our country, the U.S. savings rate is now at 8%, which is quite remarkable given Americans typically don't save. If you remember, we went into the last recession with a basically zero savings rate, and of course that created a very severe dislocation for private people and consumers. So what does this affect in terms of the market? The most economically sensitive parts of the market are most severely affected by all of this. You're seeing this play out in semiconductors. We've now eliminated pretty much all of our exposure to semiconductors. These are basically chips for everything from PCs to servers to 5G. We own none of that anymore. And the other area that's being affected now are energy stocks. We have basically no exposure there either. Where you can hedge yourself against these types of things is in asset classes like gold. We've highlighted that before, so we have some exposure to gold in some of our more conservative portfolios. From a stock selection point of view, recurring revenues, very important here, so non-cyclical type revenues. And you even would consider utility stocks that obviously have recurring revenues. So we like stocks like NextEra, which is not only a utility stock, but it has a growth component to it, and that's really in wind and solar power, which is really a growth industry in the United States as well. So the other asset class is real estate. We own two REITs, Crown Castle and American Tower. These are structured as REITs, but these are obviously cell phone towers. In a low interest rate or no interest rate environment, these types of assets tend to do quite well. So we're watching this whole political environment unfold. So we're getting ready for more volatility and watching how this is going to affect earnings going forward. Again, we just went through the earnings season. It was quite strong, so there's no need to run for the hills here in terms of worrying about a recession tomorrow, but we would still argue that the danger of a recession coming earlier, meaning earlier in 2020, is now something we need to look at. And when we're looking at stock selection and asset allocation, we have to keep that in mind. So that's it for this week. See you next week.